Well, the trend right now is lower yields on my screen, lighting up big time. The 2-year down by about 19 basis points, the 10-year down by a similar amount. We're pricing in more rate cuts for 2024. That's the conversation as things stand. Erin Browne, the conversation in DC has been the same one for the last 10 years. Governance issues. Should those governance issues lead to higher yields? Does it make it more expensive for this government to finance the deficit, given the dysfunction in Washington?
Yeah, I think like the prior speaker just said, I think that the increased dysfunction that we've seen over the last decade or so does lead to more risk premium being priced into 10-year Treasury yields. And really, the dysfunction makes it more difficult for smooth government financing to occur, for the government to fund its deficits, to really, focus on its priorities. So I think that does, import some modest amount of higher yields on treasuries, but it's very hard to be able to disentangle how much is coming from, increased risk of government dysfunction. But I do think it matters.
This treasury market just looks like a mess, Robert Tipp. Last week we had a sloppy bond auction on the 30-year and yields were surging by more than 20 basis points at the long end. This morning, encouraging news. Let's be clear about that. We want to see more of this. Less of last week, more of this. Further signs of disinflation. And Robert Tipp, we've got another move of 20 basis points, this time at the front end. Robert Tipp, what are you making of just the day-to-day price action in treasuries?
Yeah, and I want to take you back through the issuance aspect again. If you think back prior to the August refunding announcement and the Fed's shift to a higher for longer stance, we were kind of down wrapped around 4% on the Treasury. And now we're up in more of like a 4.30 to 5% range. So I think the downgrades and the supply are really weighing on the back of the market more visibly than before. In terms of the day-to-day movements, that has been a feature. I think investors are really disoriented here. I think they're missing two aspects of the landscape here. The first one is that we were in a 10-year Treasury environment that was averaging about 2%, and now we're going to be up in a world that's probably in the 4 to 5% realm for the foreseeable future. As Erin was alluding to, I think inflation is going to be sticky above 2%. And growth, for a number of reasons, I think is more resilient than people expect. As a result, even if you got the Fed funds rate coming down to 4%, and that is not on the Fed's radar, right, over the next year, you still, with a positively sloped curve, could have treasuries right in this realm. So I think the markets have not wrapped their head around the paradigm shift up to higher yields, which are much more normal. The second aspect is the cyclical. They haven't wrapped their mind around the fact that the Fed is likely to get marooned at 5 for quite a while, above 5, then a bit below 5, and that is going to be a serious influence on the bond market and the general range of yield. So while the market's in that realm of confusion, you're having these really violent day-to-day swings, and I think that's going to continue within an overall range around where we are here, kind of 4.30 to 5%.
What you just said is at the epicenter of a massive debate on Wall Street going into 2024, Robert. Erin, I want to share this view from UBS's Banner Buwaja, who says the following: we don't see the conditions for why this time is so different. Inflation is normalizing quickly, and by the time we get to March, the Fed will be looking at real rates, which are very high. The view from UBS is that rates fall to between 2.5 and 2.75 by the end of next year, and the terminal rate plunges to 1.25 by early 2025. Clearly, Erin, that's a view on the other end of the spectrum. Do you think they're wrong?
I do think that they're probably, probably early in that call. Certainly I do think we'll see rates by the end of the cycle normalize back to the levels that they suggest. But I think in the very near term, it's going to be difficult to achieve, because what's different this time is that we really had an inflation scare that was persistent and well above the Fed's projections, either at the start of or the middle or even towards the end of the inflation cycle. And so it it lasted much long. It was more of a supply-driven shock, which had ramifications multi-months and multi-quarters, and they continually had to revise up and were proved wrong with respect to their expectation for inflation normalizing. And so I think that recent shock will keep them a little bit more reluctant to aggressively cut rates this cycle, like you've historically seen during prior rate cutting cycles.